Did the Bank of Canada just make another mistake by only hiking half a percentage point today? We're going to talk about that and the extra interest you're going to pay and what it means for home prices next on MortgageLogic.news. Welcome, folks. I'm Robin Klister. The Bank of Canada surprised us today with 50 basis point hike to its overnight rate. It was a surprise because people expected 75. Now, time's going to tell, but the Bank of Canada might have made another mistake today by not hiking as much as the market was prepared for. Why? Because not enough people believe inflation is coming down. The BOC's own data show that Canadians expect inflation to remain 150% over target for at least another 2 years. And 53% of Canadians, based on a BOC survey, don't even know the BOC has an inflation target. And the other half think the target's nearly 3%. Now, long story short, not enough people believe that the Bank of Canada tightening is going to move the inflation needle. And on top of that, we got a labor market that is crazy tight right now. It empowers people to ask for inflationary wage increases, and that could potentially create a wage price spiral, which is one of the worst nightmares of any central banker. Now, if history shows anything, it shows two things. One, central banks must hike more than the market wants when it's behind on fighting inflation. And two, the overnight rate must be higher than the core inflation rate if we want price pressures to subside fast enough. Now, we're not getting there quick enough. The overnight rate is only going to 4.25% if you believe the bond market's forward pricing. But core inflation is a point above that at 5.3%. And then there's the wild cards. Things could easily come out of left field to jam inflation higher. Escalation in the Russia-Ukraine conflict, Chinese trade disputes, oil shooting above $100 a barrel, the loonie diving more. The takeaway is this: it's too early for the Bank of Canada to get softer on inflation. Hiking 50 instead of 75 sounds welcome if you got a lot of debt and your interest payments are high, but it actually raises the risk of mortgage rates staying elevated for longer. And remember, even though we're headed towards a recession and high inflation can coexist. Okay, refer to the 1970s and stagflation. That's all the proof you need. Today's 50 basis point hike is going to take many adjustable rate mortgage payments almost 50% higher if you compare them to the payments on March 1st. For variable rate borrowers, more of them are going to hit their trigger rates and see higher payments. But we're still talking about a minority of the floating rate market seeing these trigger rate increases. And the reason is simple. The average variable rate in the past 5 years has been about 2.5%. So it's going to take at least 300 basis points above that to trigger wider scale trigger rate problems. So we got another 50 basis points or so to go. And on the fixed rate side, some of the pressure is off now. We saw the 5-year yield plummet 25 basis points after the Bank of Canada announcement today. That's the biggest drop in the 5-year since 2011, by the way. Whether it's the market thinking the Bank of Canada is pivoting soon here or not, I don't know, but the yields are down significantly, and probably that sets some type of trend, at least until we see an announcement out of the Fed, and they're expected to hike 75 basis points, which could add a little bit more concern to the market and push up Canadian yields a little bit. Now, we'll probably see some easing soon on insured longer-term fixed rates, assuming that yields don't bounce back. For uninsured fixed rates to drop materially, however, we're going to need to see more things happen, like the 5-year yield get closer to 3%, credit spreads to improve a little bit, volatility to die down in the market, more stability in the housing market, since housing risk is a factor in mortgage pricing these days. The message here is that rates are far less responsive to drops in yields than they normally are. So it's going to take, I think, a material drop in yields here to see meaningful reductions in fixed rates. Whenever the Bank of Canada takes rates higher, mortgage shoppers always want to know the same thing. How does it affect term selection? So term selection, as you probably know, is a very personal thing. But in general, today's Bank of Canada rate hike doesn't change all that much with term selection. The one-year fixed still performs best in rate simulations, followed closely by the two-year fixed. Now, of the two, two-year is much more of a safeguard in the event the Bank of Canada has to get more aggressive than expected to bring inflation down. Now, the thing to remember with short terms is that they're riskier. They're much more suited to well-qualified borrowers with a financial safety net. Now, a reminder as well that rate simulations can't see the future. So projected performance is based on implied future rates in the bond market, rate spreads at renewal, a whole bunch of other things. And it's subject to error, especially if we get another global crisis. Most people think inflation's already peaked. But what many forget is that this inflation that people are talking about is headline inflation. Headline inflation topped out so far at 8.1% in June. But what matters far more is core inflation. Core inflation is annoyingly persistent at 5.3%. We need it back below 3% to see meaningful decreases in mortgage rates. Problem is, core could stay higher for longer than we think due to all the structural factors driving inflation. Supply chains, trade frictions, wage pressures, service inflation, corporate exploitation, you name it. And people often ask me, how much tightening might it take to get core inflation back on track? And I'm not Merlin the magician, so I don't know the answer, but it's not outlandish to think prime could surge by similar proportions as it did in the last inflation crisis of this magnitude. In 1981, prime increased 2.75 times. And if that happened this time around, it would take prime to a very plausible 6.75%. Now remember, we're already at 5.95% today. Long story short, if you're a borrower or mortgage advisor, the point is prepare for the worst on rates and hope for the best. Rate hikes never help home prices in the short term, and today is no exception. The minimum qualifying rate or stress test rate for uninsured mortgages rises from 6.95% to 7.29%. That's based on the lowest nationally advertised rates. Now that's going to shave a few percent off of one's maximum theoretical purchase price, at least to the extent that the person is buying as much home as they can afford. But from here on out, as long as we don't make a new high in yields, it's possible that affordability doesn't deteriorate tremendously more, at least due to the stress test, that is. And if you fast forward to the Bank of Canada's January meeting, if we see the Bank of Canada indicate noticeably less willingness to hike rates in 2023, I think you're going to see the housing market psychology change, and prices might be set up for somewhat of a bounce in the spring market. Now, if we see a surge in sales around that time, that'll probably indicate that we are also near at least a short-term bottom. You always, very often, you see a lot of activity at turning points. Now, with unemployment expected to spike in the first quarter, how long we drag along the bottom or how high we bounce is anyone's guess. But either way, I mean, if you're well qualified with a long-term holding time frame and you get a chance to buy in the first quarter or second quarter at 20 to 30% off the 2022 peak, consider it an opportunity. We know the fundamentals are still going to be there ultimately, and we're talking household formation, tight supply, rate reversals, all of these things and more are going to support values in due course. Again, assuming, as always, no black swan events. That's a wrap for today, October 26th. We'll do these videos for subscribers at least quarterly or whenever there's major mortgage news. And if you found the information useful, it would mean a lot to us if you like, share, and subscribe. And for in-depth financing strategies, rate outlooks, and industry intel found no place else, sign up for our member bulletins. They come out every Tuesday at MortgageLogic.news. Membership's $99 a month, and we work hard to make sure that your ROI is several times that investment. In the meantime, I hope you enjoyed this video. I'm Rob McClister. Thanks for watching, and finance well.